Welcome back to the deep dive. Today we're doing what we do best, taking some pretty dense corporate material, financial reports, all that stuff, and really turning it into something you can actually use.
Yeah, something accessible.
Exactly. And the company on our sites today is one of those giants that, kind of operates just outside the big headlines. We're talking about Cincinnati Financial Corporation.
Or CINF, as you'll see it on the ticker.
Right, CINF. And what we have in front of us is, well, it's the whole blueprint. A really comprehensive corporate profile. We've got the history, the scale, which is staggering, and this really unique structure they have.
These different pillars of the business.
Yeah, and the strategic moves that really define them.
Yeah.
And our goal here isn't just to, read off a list of facts. We want to understand the whole system. How does this company, with these deep Midwestern roots, also have this surprisingly global reach?
That's the mission. For anyone out there studying U.S. insurers, CINF is, it's a mandatory deep dive. Their success is all about diversification and this incredible loyalty they've built.
Loyalty with their distributors.
Precisely. So we're going to cut through the jargon, the numbers, all the way down to things like Syndicate 318 and SFAS 133.
Ooh, okay.
Yeah, it gets specific. But we want to show you the levers they pull, where the capital comes from, and why their structure is just such a powerful model for stability in what can be a really volatile industry.
So before we get into the weeds, let's just set the table. Let's acknowledge the kind of company we're dealing with here.
It's a serious player.
A very serious institutional presence. It's publicly traded on the Nasdaq. It's a component of the S&P 500.
The benchmark index, yeah.
And it holds a spot in the Nasdaq Financial-100 index. So, these are all signals that tell you you're looking at a company with undeniable size, stability, and market influence.
No question.
Okay, let's unpack this. I think we have to start at the very beginning because their founding story really seems to dictate how they operate even today.
It really does.
Yeah.
You have to anchor CINF in its specific history and its geography. This is not some coastal finance powerhouse.
Not a Wall Street firm.
Not at all. It was founded in 1950. So, just think about that for a second. Based on our source material, that means it has roughly 75 years of experience.
And in the insurance world, that kind of duration, that history, it's everything, isn't it?
It matters immensely. 75 years of underwriting experience, of capital accumulation, of market data. Risk management is fundamentally about analyzing the past to predict the future. So having a long past is a massive asset.
And the geography you mentioned, that's a defining piece of their identity.
Absolutely. They were founded right there in Cincinnati, Ohio. Their operational heart is still in Fairfield, Ohio, just nearby.
Mm-hmm.
When people think finance, their mind immediately goes to New York or maybe Chicago.
Right.
But CINF is this perfect example of the enduring power of these major financial institutions that grew up in the American Midwest.
And you can feel that Midwestern identity in their whole business philosophy, which I think you could argue is their single biggest differentiator.
I would argue that yes. The origin story that matters most is this. CINF was founded by 4 agents. It was spearheaded by 2 brothers, John J. Schiff Sr. and Robert C. Schiff Sr.
Founded by agents.
By agents for agents. The whole company was explicitly built to serve and support the independent agency model. That's the key.
Okay, so let's break that down. Their entire identity is built around making the local independent agent successful. This isn't a direct-to-consumer model.
No, you won't see a big Super Bowl ad from them.
And they're not using captive agents either who, can only sell one company's products.
Precisely. It creates this incredibly powerful loyalty loop that they established way back in 1950. The independent agent is CINF's customer, in a way. They're the primary distribution channel.
And you have to keep that in mind when we talk about their structure later on.
Yes, especially their internal financing arm. It explains these unique investments they make in their own sales force. It all comes back to that founding principle.
All right, so let's get to the core product. The source material is crystal clear here. The primary focus, the massive engine driving everything else, is property and casualty insurance.
Yep.
That's the stuff that protects your house, your car, your business from damage, and also liability if you cause damage to someone else.
P&C is absolutely the bedrock. And even within that, they have this subtle but really important structural segmentation.
How so?
Well, they deliver their P&C products through 3 different entities: the Cincinnati Insurance Company, the Cincinnati Indemnity Company, and the Cincinnati Casualty Company.
Okay, so why? Why have three different companies doing what sounds like basically the same thing? Why not just have one big Cincinnati insurance company?
It's a great question. And it's pretty standard practice for big insurers. It serves really two main functions. The first is risk segmentation,
Meaning,
meaning you can put different types of risk into different legal buckets. You might put your most complex, highest severity commercial property risks into, say, the indemnity or casualty company.
and keep the main company for the more standard stuff.
Exactly.
Yeah.
You reserve the less volatile risks for the original Cincinnati Insurance Company. This isolates risk exposure and protects the balance sheet of your flagship entity. It's a firewall.
And the second reason.
It often comes down to regulations and licensing. It's complicated, but having multiple admitted carriers lets them tailor their underwriting rules and their capacity to different states. A high-risk coastal state has different needs than a low-risk Midwest state.
So it gives them operational flexibility. What looks like complexity on the outside is actually a tool for them on the inside.
That's it, exactly.
So the next logical question is, okay, how big is this P&C engine? The U.S. market is just this enormous, sprawling, fragmented beast.
It is truly massive, which is what makes CINF scale so impressive. Our data says that Cincinnati Financial ranks as the 20th largest insurance company by market share in the U.S.
20th. Which, might not sound like number one, but in a market with literally thousands of players.
Exactly. Being number 20 puts you in the absolute top percentile. We're talking about thousands of companies, regional specialists, global giants, everything in between. So being the top 20 signifies huge brand recognition and, more importantly, massive regulatory trust.
And we have the specific number for their market share, which I think really drives home that idea of fragmentation you mentioned.
We do. CINF holds 1.01% of the total domestic P&C insurance premiums.
1.01%.
Yes. And you might look at that and think, wait a minute, the 20th biggest company in the country only has 1%.
Right.
And that's precisely the aha moment. That's what we want you, the listener, to really grasp about this industry.
Let's really spend a minute unpacking that 1.01%. It tells two different stories at the same time.
It does. The first story is about CINF's raw financial power. 1% of the U.S. P&C market is still a multi-billion-dollar operation. It's what allows them to build up the nearly $28 billion in assets we're going to talk about later. It confirms they are a powerhouse.
But the second story is about the playground they're in. It's the competitive landscape.
And it is fierce. If CINF, this huge, diversified, established company, only commands 1% of the market, it tells you that the industry is just intensely competitive. It is incredibly fragmented.
There's no one dominant player who can just dictate prices or terms.
Not even close.
Yeah.
And that constant pressure from fragmentation is what drives CINF's strategy. They can't win on sheer size alone. They have to win on specialization, on underwriting discipline, and, crucially, going back to their founding on superior service to that independent agent network.
That 1.01% means they are in a constant battle for every policy, fighting against 19 bigger competitors and thousands of smaller, nimbler ones.
It forces them to be smart. It forces them to diversify, which is the perfect segue to the next part of their structure. If they just stuck to standard P&C and accepted that 1%, they'd stagnate. They have to find other places to find higher margins or non-correlated revenue.
It's the perfect setup. You have this solid but incredibly competitive core business, which means you have to build strategic pillars all around it.
You need buffers.
Right. So we've established the P&C Foundation. Now let's get into that broader structure that takes CINF from being just a stable insurer to a really sophisticated financial institution. This is where it gets really interesting.
It is. This is where you see them using their capital strategically to build multiple streams of revenue and, maybe more importantly, stability.
Why is that so important?
Because insurance, especially property insurance, is a volatile business. I mean, one massive hurricane, one season of wildfires can wipe out an entire year's worth of underwriting profits.
So you need something to smooth out those bumps.
Exactly. And for a publicly traded company that's aiming for consistent growth, diversification is the only solution. And CINF has built three major pillars on top of that P&C foundation, and each one serves a very specific purpose.
Okay, let's take them one by one. Pillar number one provides that stability you're talking about, life and annuities.
Right. This is handled by the Cincinnati Life Insurance Company. The products are what you'd expect: life insurance, disability income insurance, and annuities. And this is a classic, almost mandatory move for a big P&C carrier.
And it's all about the nature of the cash flow, right?
It's all about the cash flow. We should spend a little time here because the difference between P&C cash flow and life insurance cash flow is where the real capital generation happens.
Go for it.
Okay, so P&C is what we call short tail. You pay your premium today for a policy that usually lasts a year. A potential claim, like a car crash or a house fire, happens relatively quickly. The insurer gets the premium and has to be ready to pay out that claim pretty soon.
So they hold the money for a short time.
A short time, yes.
Yeah.
It generates what we call short-term float. That's the money the insurer holds and invests between receiving the premium and paying the claim.
But life insurance and annuities, that's the opposite. It's long tail.
Exactly. Think about a 30-year term life policy or a retirement annuity. CINF is collecting premiums for decades, potentially, before they ever have to pay out a claim.
Which creates a massive stable pool of capital.
That's the float. A huge, predictable pool of capital that can be invested over a very, very long time horizon. And that longevity is what smooths out the peaks and valleys of the P&C business.
So if CINF has a terrible year for hurricanes,
The life division doesn't care about hurricanes. It's still just chugging along, churning out decades worth of stable premium income. It's a fantastic stabilizer.
and that stability must give them more confidence in their investment strategy. Because at the end of the day, insurance companies are really investment companies first.
They absolutely are. The real profits often come less from the underwriting itself. Collecting $1 in premium and paying out 95 cents in claims, and more from investing that floats successfully over many years.
So the stable cash from the life company provides this long-term capital base for Pillar 2.
Which brings us directly to Pillar 2, asset management, run by CinFin Capital Management Company.
This is where they formalize their role as an investment firm.
That's right. They have to manage billions of dollars in float to make sure they can pay claims that might not come due for 30 or 40 years. CinFin Capital manages that portfolio for them. But, and this is the crucial part, it also provides those same asset management services to external clients.
Who are they selling to?
Institutions, other corporations, high net worth individuals. They're essentially taking an internal necessity, managing their own money, and packaging it as a fee-based service they can sell to the outside world.
And that synergy is so powerful for them strategically.
Because it creates what we call a non-correlated, non-underwriting revenue stream.
Meaning it has nothing to do with insurance claims?
Nothing at all. CinFin Capital is generating consistent fee income for managing other people's money, regardless of whether the weather is good or bad, or if P&E claims are up or down.
So they're monetizing their own expertise.
Perfectly put. If the life side is generating billions in float, and your internal investment team is doing a great job, you can leverage that reputation to attract outside money. It's a buffer. If underwriting profits are thin one year, the fees from investment management can pick up some of the slack.
It's a very robust, layered approach.
Yeah.
Okay, that brings us to Pillar 3, which is, I think this one is the most fascinating. It's the organizational quirk that tells you the most about CINF's real identity.
Financial support and leasing.
Right, handled by the CFC Investment Company.
And you're right, this gives you such a deep insight into their strategy. The company's function is to support the insurance subsidiaries and specifically their independent agent representatives through commercial leasing and financing.
Okay, I have to challenge this a bit. In a world full of commercial banks, specialized lenders, why would a multi-billion-dollar insurance company get into the business of leasing office equipment to its own agents? Isn't that tying up capital that could be earning returns somewhere else?
It's an excellent question. And the answer isn't about maximizing lending profit. The answer is about control and loyalty.
Back to the founding story.
It always comes back to the founding story. CINF's success is completely dependent on the success and loyalty of those thousands of independent agents. So let's say an agent needs to upgrade their office tech or lease a new fleet of cars for their team.
They could just go to a local bank.
They could, and that bank would dictate the terms. And now that agent is focused on their debt to an outside party, and maybe they're a little less loyal to CINF. Maybe another insurer comes along with a slightly better commission.
But if CINF is the one providing the financing...
Exactly. By using CFC Investment Company, CINF becomes the preferred internal financing partner. They can ensure their agents have the best software, the best equipment, under favorable terms that just reinforce the relationship. It's not about the interest rate they charge. It's about maximizing long-term distribution loyalty.
So CFC Investment Company is basically a loyalty program disguised as a bank.
That's a great way to put it. They are facilitating, maybe even subsidizing, the very infrastructure of their own sales force.
It creates this closed-loop ecosystem. The agent relies on CINF for financing, which strengthens the relationship, which makes them more likely to place their best business with CINF's insurance products.
It's a brilliant specialized use of their capital. It's all about protecting and enhancing their core advantage in that super competitive 1% market. In a fragmented market like P&C, distribution is king. If you support your distributors better than anyone else, you protect your market share.
So that multi-pillar structure gave them incredible domestic stability. But to really grow and become relevant on a global scale, they had to evolve. Let's shift now to two really critical pivots that shaped the CINF we see today.
Right, and the first of these was their very intentional move into a market called excess and surplus lines, E&S.
And our sources pin this move to 2008.
A very telling year, 2008. A lot of people were reevaluating risk.
So they set up a dedicated company for this, Cincinnati Specialty Underwriters Insurance Company. We need to define E&S for everyone. What is it, and why was 2008 the perfect time to jump in?
Okay, so E&S is the market for risks that the standard insurance market, the admitted carriers, like the main Cincinnati Insurance Company, won't touch or can't touch.
Why not?
Because standard carriers are heavily regulated by states on things like policy wording and especially pricing. E&S carriers operate in the non-admitted market, which gives them far more freedom to customize policies and price unique, complex risks.
So if you're trying to insure something really unusual, like a brand new type of factory or a huge music festival or even political risk for a project overseas, you'd go to the E&S market.
That's it exactly. These are higher complexity, higher severity risks. But they often carry much higher profit margins because the carrier can use its expertise to price the risk accurately without being constrained by regulations.
And doing this in 2008 when the whole financial world was shaky?
It was a very calculated, strategic move. They were looking for insulation from the general economy. They were looking for niche markets where specialized expertise could command premium prices.
It's a move away from commodity insurance.
It absolutely is. It marked CINF's transition from being just a generalist insurer to also being a specialty risk underwriter. It showed they were willing to take on unique, high-margin risks to diversify their portfolio away from, standard home and auto policies. And it really laid the intellectual groundwork for their next and biggest leap.
The global leap. This is the truly transformative move. This is in 2019, and it's where CINF goes from being a major U.S. player to a genuine international player.
This is the critical moment in their modern evolution. In February 2019, they acquired a company called MSP Underwriting, which is a specialist underwriter based in London.
The heart of the global insurance market.
One of the two great hubs, yes.
Yeah.
And they immediately rebranded it as Cincinnati Global Underwriting Ltd. They established their international headquarters right there.
But buying a London company is one thing. The really critical part here, the key insight for our listener, is the mechanism. How did this specific acquisition give them access to the most elite global risk market on Earth?
It gave them access through the centuries-old institution known as Lloyd's of London.
Okay, this gets dense. The source material has the specific architecture.
It does. It says, Cincinnati Global operates through Cincinnati Global Underwriting Agency Ltd., which is the Lloyd's managing agent for Cincinnati Global Syndicate 318.
Okay, let's unpack every piece of that sentence. We have to go slow here. Let's start with Lloyd's itself. It's not an insurance company, is it?
No, it's not. That's the most common misconception. Lloyd's is a market, an exchange. It's a physical and electronic space where the world's most unique, massive, and complex risks are traded.
Like what?
Think global aviation fleets, multi-billion-dollar offshore oil rigs, priceless art collections, even things like satellite launches or geopolitical risk.
The kind of stuff no single company could insure on its own.
Exactly. And the risk isn't taken on by Lloyd's. It's assumed by individual underwriting entities within the market. And those are called syndicates.
So Syndicate 318 is CINF's team. That's their capital and their underwriters sitting in the Lloyd's market, taking on these complex risks.
That is precisely what it is. The syndicate, number 318, is the actual underwriting vehicle. It's the team and the pool of capital that legally assumes the risk.
Okay, but this source also mentioned a managing agent.
Right. A syndicate doesn't run itself. It needs a manager. And that's the role of the Cincinnati Global Underwriting Agency Ltd. It functions as the managing agent for Syndicate 318.
A role that CINF now owns. And what does a managing agent do?
They're the administrator, the strategist, the compliance officer. They're the ones who manage the underwriters. They decide which risks Syndicate 318 will take on. They manage the capital, and they made sure everything complies with the very strict rules of the Lloyd's market.
So by buying MSP Underwriting, which was already an established Lloyd's managing agent,
CINF instantly bought two things they could never have built quickly on their own: infrastructure and credibility.
they completely bypassed years of trying to build a global presence from scratch.
Completely. They could immediately leverage the billions of dollars from their domestic P&C and life businesses, all that float we talked about, and deploy it in the most exclusive, high-value risk exchange on the planet.
This just fundamentally changed their identity. They went from being a huge regional P&C insurer to a global specialty risk underwriter.
And that geographic diversification is massive. I mean, if the U.S. P&C market is having a soft year with low rates, CINF can now look to high-margin opportunities in London, ensuring a major shipping lane, a satellite launch, whatever, to maintain their profitability is the ultimate expression of sophisticated capital deployment.
Okay, so we've built the whole complex structure. We've seen the strategic moves. Now let's put some hard numbers to it. Let's look at the raw power of the balance sheet. We can use the metrics from the fiscal year ending December 31st, 2020 to really cement the scale of this operation.
These numbers are the proof of concept. They show that the blended model really works. You can see the stability from the core P&C, the long-term capital from the life business, the fee income from asset management, and now this capacity to underwrite global risks through Lloyd's.
Let's run through the headline figures from that 2020 report. We've got revenue at $7.536 billion.
A huge top line.
Operating income, $1.499 billion. Net income, $1.216 billion. And then the balance sheet figures. Total assets, $27.542 billion.
An enormous asset base.
And total equity at $10.789 billion. The scale is just immense. But let's dig into the financial health here. First, that relationship on the balance sheet between total assets and total equity. That's the signature of an insurance company.
It absolutely is. You see $27.5 billion in assets, but only about $10.8 billion in equity. And that huge gap, what is that, roughly $17 billion? That's not a deficit, that's the business model.
That's the liability.
That's the liabilities. That $17 billion represents primarily the reserve they've set aside to pay future claims. It's the money they owe to their policyholders.
In other words, that's the float. That's the nearly $17 billion that CINF is entrusted to manage and invest while it waits to pay claims.
Correct. And the significance of that $10.8 billion in total equity is that it represents the surplus. It's the cushion. This is the company's own capital, owned by the shareholders, that sits on top of all the required reserves.
And regulators must love to see a big number there.
Regulators demand it. They require a healthy surplus to prove that the company can handle unexpectedly large losses, a mega catastrophe, without going under. So having a surplus that big signals profound financial strength. It's crucial for a company playing both in the U.S. and in the high-stakes Lloyd's market.
Okay, and if we shift to the income statement, that relationship between $7.5 billion in revenue and $1.2 billion in net income, that seems pretty efficient.
It demonstrates very strong profitability. I mean, a net profit margin in the mid-teens for a complex financial firm like this suggests that two things are working really well at the same time.
What are they?
One, they have disciplined underwriting. They aren't paying out too much in claims relative to the premiums they're collecting. And two, they're getting successful performance from their CinFin Capital investment arm. You have to remember, in any given year, the investment returns can often be a bigger contributor to the bottom line than the underwriting profit itself.
Which brings us to an interesting little detail our source material picked up on, an accounting adjustment from back in 2001.
Yes, this is a deep cut, but it's a great illustration of how carefully these big institutions have to manage their reporting. Back in 2001, CINF had to make adjustments related to something called SFAS 133.
Which is?
It's a GAAP accounting standard that deals with how you account for derivative instruments and hedging activities. Derivatives are just complex financial tools that CINF uses to manage risk in its massive investment portfolio.
And the change was about where the gains or losses from those derivatives showed up on the income statement.
That's it. The source notes that CINF started including these adjustments with realized capital gains or losses instead of classifying them as investment income. Now, the actual amount was small, only a $1.3 million after-tax gain for that period.
So why does it matter? Why the fuss over $1.3 million and which line item it goes on?
Because analysts view those two line items very differently. Investment income is seen as stable, recurring, predictable. It's the interest you get from bonds, dividends from stocks. Realized capital gains, on the other hand, are seen as more volatile and transactional.
So by making that change, they were giving a more accurate picture of the nature of their earnings.
Exactly. They were clarifying for the market the predictability and the source of their investment results, and also ensuring they were compliant with evolving accounting standards. It's a tiny technical detail that just speaks volumes about the level of scrutiny required in financial reporting at this level.
And managing a system this layered, P&C, life, asset management, global specialty, that internal financing arm, it must require a huge number of talented people.
Oh, the human element is enormous. Our source puts the employee count at 5,426 people as of December 2023. And that number really connects the billions of dollars to the actual organizational machine required to run it.
You're talking about actuaries modeling hurricane risk in Ohio.
And specialized underwriters pricing political risk in a London syndicate, and independent agents selling policies in small towns, and all the financial managers overseeing the portfolio. It brings the scale of the operation down to a human level.
Okay, finally, let's talk about their identity as an investment. We know they're in the S&P 500, but there is one specific designation they hold that just perfectly encapsulates their entire strategy and identity.
The dividend aristocrat status.
The dividend aristocrat.
This is probably the single most powerful marketing tool CINF has with the investment community, because you can't buy it. It has to be earned over decades of discipline.
So what does it mean?
To be an S&P 500 dividend aristocrat, a company has to be in that index, and it has to have successfully increased its dividend payout to shareholders for at least 25 consecutive years.
25 straight years of dividend increases. Not just payments, but increases.
Increases every single year.
So that means through the dot-com bust, through 9/11, through the 2008 financial crisis, through years with record hurricane losses, through a global pandemic, CINF has consistently found a way to not just pay, but raise its dividend.
It is the ultimate proof that their diversified structure works. You
Right.
simply cannot achieve that kind of record unless you have multiple reliable streams of cash flow that can offset volatility in any one area.
So when P&C underwriting has a rough year,
The stable life insurance float and the fee income from the asset management business step up to fill the gap. When the U.S. market is slow, maybe the global specialty market through Syndicate 318 delivers some exceptional returns.
so that status signals to an investor that CINF is a mature, conservatively managed business that's focused on long-term, stable shareholder value. It's an income investment, not a speculative growth stock.
And that consistency is the end result of every single structural choice we've just analyzed.
So after all that, what does this all mean?
It means that Cincinnati Financial is just a masterclass in how to build specialized, diversified scale. Their identity is this dynamic blend. You have the stability of their traditional regional roots, anchored in that agent-focused P&C business,
The Ohio-based core.
the Ohio core. And then you have it overlaid with this incredibly sophisticated international financial maneuvering.
The layered structure is their genius. They leverage the long-tail capital from the life company, they monetize their investment know-how with CinFin Capital, and they protect their most important asset, their agents, with the CFC Investment Company.
But the strategic high point, the thing that really sets them apart in the modern era, is that global leap. By buying MSP Underwriting and getting control of Syndicate 318 at Lloyd's, CINF transformed itself. It went from being the 20th biggest domestic insurer to being a real player in high-complexity global risk.
They successfully mixed that conservative Midwestern ethos with the specialized high-stakes ecosystem of London.
It's an incredible blend.
And that's what makes CINF such a compelling case study. We've tried to pull back the curtain on the mechanisms, the float, the leasing company, Syndicate 318, that let them maintain that consistent profitability and that coveted dividend aristocrat status.
Indeed. And this whole complex structure, it leads us to one final provocative thought for you to chew on. The company's success relies equally on two very different worlds. It relies on its decades-long relationships with independent regional American insurance agents in places like Ohio.
Right.
And it relies on its cutting-edge participation in the hyper-specialized, fast-moving global market of Lloyd's of London. So the question is this. Considering the vast differences in culture, in speed, in regulation between those two worlds, how does CINF's leadership manage the massive organizational and cultural tension required to keep both the regional agent and the global underwriter happy, productive, and operating harmoniously under the same corporate roof?
That's the real challenge.
That is the real ongoing challenge of maintaining that kind of strategic diversity.